Good.
Got it. Hi, everyone. My name is Engin. I am usually in London. I'm in Istanbul today. We'll be coming back on Friday. Let's see if I can do this in 60 seconds. I'm originally from Istanbul, Turkey. I grew up here, finished high school here, went to the US for college, studied economics, political science, graduated in 2002, started working in New York, moved to London, moved to Hong Kong, moved to Tokyo, was supposed to be for 1 month, stayed there for 17 years. I was in banking for most of it, doing investment banking, really. I was investing in other financial institutions for about 12 of those years, invested about $1 billion of equity, and then did about 5-6 years of real estate finance, commercial real estate finance, mainly in Australia, where I lent out about $2.5 billion of debt to real estate projects, or not projects really, backed by real estate. And then I was on the side producing films. I produced about 8 films, which led me to combine film and finance. I became the CFO of Mubi, which is a film platform. I moved back to London after about 18, 19 years. I was the CFO there for 1.5 years until about 2 years ago. I went back to school to study I think I'm already past 60 seconds, to study Web3 music and try to figure out what I wanted to be when I grew up. In the shower one day, I was trying to figure out how to replicate one of my earlier angel investments that had come out with some liquidity. I figured instead of me showing up with 5K or 10K checks, I might as well get a group of my friends together and we could do it together. So that's how 2121 came about. 21 friends I've known for more than 21 years. We look at deals together and we invest together, whoever's interested in investing. It's not a fund. Everyone decides on each investment. We've done small checks like 25K. We've also, our biggest check so far has been 185,000 US. And we don't have, we're very geographically widespread. We're in 13 countries. We're up to 30 of my friends now. So that's what we do. 2 of our investments I actually met through Hotbed in various programs at demo days. One is hybrid, the other one's sorry. I won't stop there, but I'll start taking questions there, right? That's what we're doing today, which I really like, because I was almost getting sick of presenting, so I like the Q&A format.
Perfect. Okay, so we're gonna talk a little bit about the three forecasts that people are probably preparing: P&L, cash flow, and balance sheet. So as a starter, which one to you as an investor is the most important or like indicative of future success?
Well, indicative of future success is a big one, but cash flow is probably, well, not probably, cash flow is the most important one. Companies go out of business because they run out of cash. If you have employees who are working for you and you can't pay their salaries, guess what? They're likely to leave. If there are people chasing after you because you can't pay what they're owed, another problem. So cash flow, I'd start with. Cash flow is the most critical out of the 3. Income statement obviously shows what you're making. That's also critically important. But if you have a lot of receivables that are not coming through, if you make a lot of revenue, which essentially, I'm not going to call it an accounting gimmick, but unless that revenue comes in cash, because you can only pay salaries in cash, it's not really going to be worth much. So the cash flow statement, I'll wrap it up with that. But cash flow is what is the most critical out of the 3.
I noticed you didn't say anything about balance sheet. Do founders, especially at pre-seed, do founders really need to prepare a balance sheet?
Good question. I'm a big fan of balance sheet because most people try to run away from it. To me, it shows basically the 3 statements. I was thinking about this earlier. How many of us in here? About 40 of us?
About 40, yeah.
I would suspect, and this includes probably a lot of scale-up founders as well. Out of 40, I would suspect maybe within 5 sentences, only about 5 to 8 of us can probably very succinctly express how the three statements link together. I hope this is an understatement, but I'm a big fan of balance sheet because if you have the three statements actually flowing properly, the balance sheet actually is a great summary of where the company is at any given time. And for me, when I receive an Excel model, the three statements linking together, that's 80% of my checking job actually done, because you've already built in the checks and balances because of the way your income statement, your cash flow, and your balance sheet are actually linked to one another. So obviously, for some businesses, balance sheet is a lot more critical. Obviously, you may not be in fintech, or you may not be actually running unbalanced or unbalanced sheet balances. But in terms of showing how the three statements actually link to one another, I am a big fan of the balance sheet actually being there.
I can guess what you're going to say to this, and I think we've covered it in other videos, but for the sake of having it all in this conversation, what are the things that you look at to make sure that the three statements are linked to each other? Oh, my fire alarm is going off. I'm going to mute myself and fire away.
Well, in terms of the three statements being linked to one another, are you asking me what the links should actually be between the three of them?
Yeah, what are those links?
Well, I won't give it away. It's for them to figure out. But obviously what doesn't work, let me take it like this. What doesn't work for me in a model is hard codes. For example, if you're plugging in certain numbers in certain places instead of stuff linking to one another, that would be an issue. But obviously the main links between the three of them, I mean, the cash balance on the balance sheet, that would be a big one, obviously coming in from the cash flow statement and then heading back out that way. And then your bottom line, your net profit, your net income, obviously feeding into your cash flow and then running down your cash flow. That would be the other one. And then obviously everything on the balance sheet, the balance is changing, does impact what shows up in the cash flow statement. So there are various linkages between them, and it really depends on what's on your balance sheet. But those would be the main ones that I've mentioned: the cash account and the net income feeding into your on your balance sheet, your retained earnings, and to the top of your cash flow statement.
What about actually, founders, if you guys have first of all, can you raise your hand if you have forecasts that you've already prepared? Either you are about to start fundraising and you've prepared them, or you're in the midst of fundraising and you have them prepared. Okay, yeah, you can either raise your hand on camera or raise it with the little Zoom feature. And then also keep your hands raised if you have a balance sheet prepared as well. You can put it in the chat too. Okay, nice. So I want to talk a little bit about profitability. It was interesting. Pardy and I were moderating a panel last week with Dan Bauer and Alex McDonald, and both of them were saying that, like, okay, so there's been so much conversation about we're in a down market now, investors care so much about profitability, and they were saying, like, hey, we're in it for the long run. Like, we'd much rather you focus on growth versus profitability. And so it seems like there's quite a disconnect between like what, I don't know, investors are saying versus like what they're posting about on LinkedIn and kind of like what the market is saying. What are your thoughts on it? And then in terms of like a 3-year forecast, do you expect to see profitability within those 3 years?
So I'll start with profitability versus growth first. I think it really, I mean, that is obviously a trade-off, profitability versus growth. If you're quite early on, I mean, if you're profitable from very early on, the question becomes, are you profitable at the expense of growth? Are you not growing at a faster pace that you could be growing at because you'd rather show that profit in your bottom line? So that is not something that a lot of investors like to see. Maybe this is a good point to distinguish between VCs and angels to a certain extent as well, because VCs obviously have their funds and they're always looking at fund returner. They're always looking for that company that's going to bring them so many times of their money back to be able to cover the whole fund and the failures that happen within the fund. So, to the extent you're not growing at that rocket sort of growth path, or VC, you may have heard the analogy. Taking VC investment is like putting rocket fuel. If you're not a rocket, it's not a good fit. Angels may still be interested in profitable growth and softer growth, which almost puts you more like more in that path of an SME. If you're willing to stay smaller but be profitable all along, you may be able to do that with a smaller amount of investment. You've probably been reading some of the stuff about, not every company has to become a unicorn. Instead of selling at a unicorn valuation and not being able to put any money in your pocket, if you have $100 million company and you actually sell that with more of the equity owned by yourself, then you're actually making a very profitable and very sweet exit. So it's almost I could even call it a lifestyle choice. It's about what you want to turn your company into. If you want to become a global brand name, and if you want a company that's going to last for 20, 50, 75, 100 years, then maybe stepping on the gas and being in fifth, sixth, seventh, whatever gear is possible, maybe that's for you. If you're actually after a company that's going to make you happy and financial returns much sooner, where you can actually pay yourself dividends with a couple of other investors and pay them dividends, then maybe profitability from early on is not such a bad idea. So in terms of what we're looking for, it's probably a mix of the two. I think in the first year or two, asking for profitability is too much. Seeing a path to eventual profitability, whether that's in the third year or the fourth or the fifth, I think that makes sense. So showing why you're growing, why you're stepping on the gas early on, but how your, let's say, unit economics or how your path will eventually take you to profitability. That's probably the most interesting story you could tell. That would be music to my ears. Growth today, eventual profitability down the road, and then hopefully profitable growth after that.
Is that something that you would want to see? Like, let's say the path, they're going to ideally become profitable in year 5, and maybe from the 3-year forecast, it's not going to make sense. So is that something that founders could add to the FAQ section, or would you then want to see a 5-year projection?
Well, I think what may make sense there, I'm a big fan of monthly projections. So what may make sense, a 5-year monthly projection might be a little too much. One, it gets really wide. Plus, after the 3rd year, monthly might be a little harder to predict. What I like to see would be, let's say, a 3-year monthly projection, 36 months of projections, and then maybe a 4th and 5th year annual projections, just to give a sense of where you think this is going to go. And this could actually be a smaller maybe part of the model. It doesn't have to be maybe all of the sheets, 4th and 5th years, but showing that you have that longer term thinking in place about where this could go in the 4th and 5th year. I think that also makes sense. Here, what's really critical is taking ownership of the numbers, not being very liberal, because everything that you put out there in terms of numbers and models, remember that people will keep digital copies of these things. So if they actually invest in 6 months and 12 months and 18 months, they will actually expect you to explain how you did compared to the numbers that you showed to your investors. So making up numbers doesn't really make sense at any stage. But then when it comes to year 4 and 5, yes, it is more of a gamble, or numbers may be harder to defend. But at that point, what makes sense is you have your monthly 3-year projections, and then you have an idea of where things might go, where your main, let's say, levers in the model how they could change in years 4 and 5. That would be an ideal scenario, is 3 years of monthly, and then fourth and fifth year, maybe cash flow and maybe income statement at higher levels, but showing that there's more juice coming down the road.
Okay, that's useful. This is such a broad question. So I guess we'll do pre-seed and seed stage companies separate. But is there a sort of like finger in the air? I don't know. I don't remember what that expression is. That's a bad expression. Anyway, what's the sort of general guideline on like what a burn rate is for a pre-seed company and a seed stage company when they're forecasting? Is there anything that you'd see that would be like, okay, you're really spending a lot, barring like health tech companies, deep tech?
No, I really don't get stuck on absolute numbers, because it's so relative. It's apples and oranges and kiwis and bananas, and you can't really fit them all, through the same hole in the wall. So I don't really have a number like that. That's an absolute number. Like if you're burning this, it makes sense. If you're not burning this, it makes sense. What probably makes what maybe is a good way of looking at this is maybe when, depending on your burn rate, when you should think about raising, probably 6 to 9 months before you are likely to run out of cash is when you should, probably 9 months before, you should really start revving up the engines. And then 6 months before, you should really be having active conversations. It always takes longer to raise. So you should never assume that, oh, things are so well, the macro climate is this and that, and there's so much money flying around. Yes, there's so much dry powder. Yes, but you should never assume that it never comes faster or as fast as you'd like it to. So whatever you're burning, just think about how long is this gonna last me? And when should I start conversations for the next round? I think that's the way to look at it. Other than that, burn 50, burn 100, burn 10. Maybe there's a golden ratio, and I should really think about this. I haven't, of whatever you raise, what percentage of that you should be burning, or how many months of burn should you be raising? But I haven't really thought about it that way, because I think it really depends on the company, and it's really different for everyone.
Makes sense. So now a few general questions. What are the key mistakes that you see founders make in their forecasts?
In the models?
Mhm.
I
know you're going to have some good answers to this.
Well, I mean, I'll start with the basics. External links. If I'm opening a file and there are external links, I will close the file and I will not open it again. That's one. If I open a file and there are refs, I assume everyone knows what refs are, numbers that don't actually show up. I'll close the model and I won't open it again. This might sound unforgiving, but if you think about it, you really need to be putting your best foot forward. And if you haven't paid enough attention to this, it might sound really small, but guess what? It always boils down to this. If you don't do your homework, I won't do my homework. So to give me a chance to do my homework, you really need, and I've tried to raise and sometimes failed at raising myself. And you got to put your best foot forward. And that is, for me, for example, if I open an Excel, I know this might sound obsessive, and it probably is. You know how I close every single Excel file? I go through all my sheets. I put the cursor in every sheet in A1. I go to the beginning and I close the file, because Excel remembers where you close the file, where your cursor is, what you see when you open it up. Put a cover page, put it in A1. If you're going to send me a model, remember, if there's one thing I look at, if I see that cursor at A1 in the corner of the first sheet, I will remember that you are actually paying attention when I was talking about this. So it's small things like that. I mean, in terms of crazy stuff, I've seen all kinds of crazy stuff. Just yesterday, I think it was my first time, I had the 5-year projections I was looking at, and this was in PowerPoint. I didn't even get to the Excel because it got me that excited. 50-year sales figure, I saw a $16 billion 5-year sales figure. And for me, that was like, yeah, right. And I didn't even bother to ask for the model. Just think about it like this: step back, take 2 steps back and look at it from the outside and be like, are these numbers actually believable? Do they make sense? Like, am I gonna be bigger than, let's say, the GDP of London if I grow this big? Am I gonna be half the size of Meta in 3 years if I actually grow this big? Just forget that you're the one trying to build this and look at it from the outside and see if it makes sense. Or just show it to a friend, or pull your mother or father and show them the numbers and ask them, does this make sense? Can something grow like this? Because at the end of the day, the numbers that you're showing, they need to tell a story. And if it doesn't make sense at first sight, it's not going to make sense if I dig deep in 2 or 3 hours. I know my answers are a little all over the place, but I'm making them up as I go along.
This is why we like having you do the financial forecast session, because we know if like something passes your quality control test, it's gonna be fine for everyone else. And it also got me thinking that the financials we just sent you were not the mouse in A1, so ignore that. We're not leading by example here, clearly. But we'll change that for next time. Anyway, should forecasts be 2 years or 3 years?
So as I said, I think it would be great to have them 3 years. It's also one thing I really care about, and is a notes page. When you send the model, always think of it like this: do I need to hold their hand and walk them through the model, or does the model stand on its own? The model, I know this will sound freaky, but is essentially a living organism that should be living on its own. So when you send it out to someone, they should be able to open it, follow it. Someone with enough financial literacy and someone who knows how to play around in Excel should be able to figure out your model. If there's any assumptions that may not make sense or may not be explicit where they come from, make a notes page and explain things, right? Just say, my churn was, 50% in the beginning, came down to 35%, it came down to 20%. Going forward, I'm assuming 15%. Just the way you would explain it to me in a video call, just put that in your notes. So when I give it half an hour, I can actually read it on my own and make sense of it. So I come back to you with more intelligent questions instead of questioning your assumptions. Or if I ask you a question and you can say, oh, I put it in the notes page, maybe you didn't see it there. Just, if you've done your homework, you don't need to make me feel bad about not doing my homework, but at least you can say, oh, I already answered it there, but here's the answer, right? So I think that's probably what I'd say for that.
Okay. I have one more question, then I'm gonna ask the questions that the cohort asked in WhatsApp, and then we'll jump to questions from our founders. Sandeep, I see that your hand's raised. I'm not sure if it was raised from the question before, but if it's not and you still have another question, keep your hand raised. And if anyone wants to ask a question live, raise your hand as well. And Harry, I'm not sure if you want to ask what we chatted about. You do? Okay, great. Then I'll go to you first during Q&A. Okay. So last question from me before our WhatsApp questions. What's the difference between a bad, good, and an exceptional forecast?
Some of the bad will be repetitive, hard codes, refs, external links, but more, let's say, a level above that, numbers that don't match. If you've actually sent me your, let's say, financials for the past year or two, if you have those, if your financials don't match the numbers in your model, that's a red flag or a question mark. I'm like, why? If they don't match, explain why they don't match. Just think about it. When you send something, if I look at it on my own, it needs to make sense. Otherwise, it's just becoming an obstacle and a hurdle I need to jump that I cannot on my own. You need to own your numbers. Someone else may have built the model, but you need to really internalize what is in that model, how things work, what links to one another. If, let's say, we're doing a live call and going over the model, if I ask you, you need to know what are the main drivers of your model. So actually, for bad, let's say not owning the model. that's a bad thing. Someone else may have built it, but you need to own the model. If you're the founder sending the model to me, you need to really understand how your model works and the numbers that it's spitting out. You can't just say, oh, that's what the model said. Doesn't work. Good. It can be understood. I guess it's a flip of the bat a little bit. It can be understood by a smart individual sitting at their computer who has looked at models before without the founder having to be there to explain. Basics, cash flow, income statement, they need to be there. A good level of sort of assumptions coming from, your sales. Don't just plug in sales figures. Show some assumptions if you're selling units or this or that, or services, client numbers, a good level of detailed assumptions underneath your top line sales figures, and then working it from there. Your costs, obviously expenses, going into some level of detail, salaries, hopefully individual salaries, especially in the beginning when you're maybe 3 to 10 people working for the startup, some level of detail that I can just digest and it makes sense. Any number that's bigger than, let's say, 100,000, I'm just making this up as I go. I think anything that's bigger than 50,000 or 100,000 should probably have some kind of level of assumption underneath, a more granular assumption underneath. I know that sounds more like exceptional, but this is really, I'd say this is really good. Exceptional, I'll come back to three statements flowing into one another, a good notes page. One of my first days back in 2002, 22 years ago, the CEO of the bank that I joined at that time, I was doing aircraft finance. He had asked, what's the most important part of an annual report? And everyone was like, cash flow, balance sheet, this, that. His answer was notes to the financial statements, because anything that companies want to hide, they can't hide it in the balance sheet, not the income statement, not the cash flow. They'll hide it in the notes. All the juicy breakdowns, all your geographic breakdowns by product, breakdowns by risk category, this and that, it's always in the notes. So the notes are the most important part. Remember, the model has to stand on its own. And for the model to stand on its own, it needs to have a good notes page. Assumptions clearly laid out. I need to be able to follow everything. I'm not going into it because, maybe it's not the subject here, but I love separating the hard codes and the calculated numbers by blue font for the hard codes and black font for any number that's calculated. So I actually know what's driving the model. What are the numbers you're sticking in there? What are your assumptions in blue font? And then what is being calculated off of those numbers. Monthly, if you're sending me a monthly model and we started talking in June and now it's September, what would impress me quite a bit is if you send me your August actuals, if you email me and say, oh, it's been 2 months since I last sent you the model, here's the September model with our August actuals, I'll be like, okay, I'll take a closer look at this. So anything that tells me you're staying on top of your numbers, your model is actually an operating model and not just some tool you came up with for financing purposes, that's, to me, is an exceptional model. When I build models for friends of mine or for my own companies, that's the kind of modeling that I try to do, is something that we could update on a monthly basis with actuals that actually gives us more insights into the company that we're trying to build. I'll stop there.
That's really, really useful. I saw so many founders taking notes during that. Okay, questions from the cohort, and let's get through these as fast as possible so we can go to live questions as well. Okay, first one, what metrics and benchmarks do you like to see?
Really depends on the company. I'm very open to listen to, well, what's most interesting is you tell me what you think your benchmarks are, what your KPIs are, and what the main drivers of your model are. So this is not a cookie cutter exercise. In a lot of this, what the investors really, or what I am looking for is, how does your mind actually work? What do you think is really going to drive your company forward? You convince me that that's what's right, and I'll look at that. So it's more of a convincing exercise than me telling you this or that, this or that.
It's almost as if you guys are asked that question during your weekly updates. So hopefully everyone has an answer for that right now.
There you go.
Coincidence. Funny how that works out. Okay, do investors care about GMV?
Uh,
Does the founder
I
who asked
only
that,
care about GMV if you try to stick GMV to me as revenue. That I care about. That I will laugh at. That I'll be like, yeah, right. So if you throw $100 million number out there and what you're making is $1 million out of the 100, I'll be like, yeah, right. I'm sure your income statement actually starts with the 100, then you pay out 99 of it. So don't try. Guess what? There's a chance that whoever is in front of you has been there before, has seen those GMV numbers before, knows what GMV is, and knows you're not keeping 95 or 99% of that. So don't generally, if you want them to be honest with you, don't try to trick. It's only going to take 10 seconds before 30 seconds before they figure it out. And to be honest, if they're that dumb to walk into that trap, you probably don't want their money anyway, because dumb money comes with a lot of consequences. So what I would say is GMV, put it outside of your three statements, have a GMV sheet, show how your GMV turns into your top line revenue, and then feed that. That's how I'd love to see it that way. That's how it feeds into your income statement. Is your revenue is your revenue. Your GMV is not your revenue. That's how I see it. I'm quite, you know, I've seen people take all kinds of, you know, pats with this one.
makes sense. One last question from the cohort. How do angel investors value pre-seed companies, and how can founders maximize valuation to minimize dilution and reduce risk later of a later down round? Big question.
How do angel investors value companies? See that finger?
That
You
was
hold
the
it up in the
expression
air.
I was looking for earlier. Okay, there we go.
Depending on how the wind blows, that's how they value the companies. To be honest, so many of several of our investments, I think 3 of our 9 investments have actually been friends and family rounds. I almost want to specialize in friends and family round investments because, to be honest, it's almost, I'm not going to say a guaranteed win-win, but any valued, like not a seed legal or a safe, but anything with a valuation at the friends and family round, because it's actually family and friends coming in, I find that that's actually a good valuation, because founders at that stage don't really want to screw their friends or family, right? So, I mean, it's really, I mean, it's an art and not a science. So, of course, what you may have heard of is 10 times revenue. That's probably, if you have any kind of revenue. If you're pre-revenue, you might as well flip a coin, 1 or 2, 2 or 5, 5 or 10. It's almost like flavor of the month. It just needs to make sense. Any number that I see, the first question I ask is, what 2 numbers did you multiply to get to that number? You just need to have an explanation. If it's 1 million, tell me, why is it 1 million and not 2? I want to invest that 2. You just cut yourself short by 50% and ask me for a 1 million valuation. Why? It's all about defensibility. Defend whatever number you come up with. If it's a valued round, I guess this is why Seed, Fast, and Safe exist, because founders don't want to get into these conversations so early on. Investors don't want to get into these conversations so early on. Do a seed fast. Get your SEIS, EIS, advanced assurance, do a seed fast. Push the valuation conversation for later. How do angel investors value it? Essentially, it's a gut feeling. I mean, once you've seen, let's say, if you see 50 decks over 2 months, you'll have an idea. And let's say if 20 of them are actually valued rounds, then you'll have an idea of what is the going rate of pre-seed. What you could study for US startups, what you could study is the Carta values. That's an extremely helpful quarterly report, state of the pre-seed or seed, whatever they call it. Study the Carta figures, and then Purdy and M will tell you what discount the UK gets compared to the US based on those Carta figures. But if you want to approach it statistically, And if you want to impress investors, tell them in the last 3 months, the average US startup in my vertical got a pre-seed valuation of this. The UK typically gets a 25 to 50 to 75, whatever the number is, hopefully not 75, discount to that. That's why I'm valuing it at this, and I'll stop there.
That's really useful. I'll just add, like, it's so, because Pody and I hear a lot of the conversations on this from the investor side, and it's so clear that at pre-seed, investors don't care that much about the valuation as long as it's not crazy. And every founder is going to get questions about the valuation, but the questions are more to see the response rather than like fighting you over lowering your valuation over $500,000.
What I tell people is what we're really looking at pre-seed is the founding team's ability to maneuver over the next 10 years and get to some kind of an interesting outcome. It will not be what we see in the deck. It will not be what we see in the model. It's the ability, when people say they invest in people, that's really what it is. It's the ability to maneuver and hopefully not give up along the way and be a survivor. I don't know what the recent stats are. 80, 85, 90% of startups die within 2 to 3 years. It's your ability to survive and not die and last 10 years. Guess what? You know, the exit I had last summer, it came after 13 years. I invested back in 2010. The exit was in 2023. Guess what happens? If you actually wait long enough and they've survived, there will be some kind of an exit coming in one way, shape, or form.
Nice. Patient capital. Okay, we're gonna go to Q&A now. Harry, you are up first. By the way, I saw some question in here about GMV. I think it's already been answered in the chat though, but if you have any more questions on that, let me know. And let me make sure screen share is enabled. Okay, Harry, you should be able to pull up your question. And then after you, we will go to you, Ivo, and then we'll take questions in the chat. If anyone wants to ask a question live, just raise your hand.
Cool, thank you. Engin, that was super helpful. Thank you. I actually came from real estate finance as well, and I thought that was complicated until I started trying to forecast my startup. So the question I was chatting to him about yesterday is basically the TAM, SAM, and SOM. You know, there's an element of finger in the air with everything, but at least, you know, working through a sort of 3 or 5 year cash flow forecast, there's some element of logic and granularity to it. Whereas those, you know, the TAM, SAM, SOM, I find just a little bit too finger in the air, and I think it's really just I want to show an investor a big number. So I'm happy to kind of work through an example of our startup specifically if that's helpful. But initial question is, what's your view and advice on those numbers, and do you want to see them in a deck?
This won't sound good, but it's probably the slide I spend the least time on. It's like, you know, for me, what really matters is you are really drilling it. I mean, I'm really interested in, I don't want to say niche, but if you have a small enough market that you can dominate, for me, that's a lot more interesting than, you know, being the next Meta. Guess what? It's the next Meta is probably not going to fall in my lap. You know, sitting in London and investing with 8 mites, but the chances, I'll be very honest, I don't like that freaking page, right? It's just like you said, it's always like people are building castles in the sky and trying to make it look so fucking big, excuse my French, and then you end up with a $16 billion sales figure in year 5, and I'm like, give me a fucking break. Like that just doesn't work, right? So for me, being realistic and showing an interesting, actually, it comes back to defensibility. If you can defend every single number in there, if you can show me you went out, did your research, and dug up really interesting numbers from interesting sources, that I care more about. Again, it's about the process. It's almost the journey, not the destination. The end numbers on there, trust me, once I've looked at a deck and I close it, in 5 minutes, I will not remember any of those 3 numbers on that page. I can assure you I will not, because I will not care enough about them. I'll remember, you know, what your 3rd year net income figure might be, but I won't remember your TAM, SOM, SAM, or whatever they're called. I even forget their names sometimes, right? So I'm happy to look at it, but I won't be your Sam expert. And, I can look, it's like that question, like those McKinsey BCG interviews ask, in their consulting interviews, how many ping pong balls in a Boeing 777, right? It's like, they're not looking for the right answer. They're looking for the process of how your mind works, how you see your market, and how you're actually going to capture a smaller portion of what's out there, right? So it's more, for me, it's more about the story that you tell around those numbers instead of what those numbers are. Again, look, I'm not a VC. A VC associate might tell you we need to see at least, $500 million, whatever Sam, whatever the smallest circle is. For me, it's not like that. I mean, we're looking at a drinks business now, and it's, it's adult soft drinks and mixers, tonics. And I'm a gin and tonic drinking man, and we're really interested because I love my tonics, right? For me, that's, the growth. If your little bubble is actually growing, for me, that's a lot more interesting than what it is today and whatever numbers associated with it. So having done that long intro, if you want to pull it up, I'll take a quick look at it, or we can take it offline and I'll look at it afterwards and I'll tell you my 2 cents, which won't be worth much.
If
Yeah,
we,
look,
I was
sorry,
just
go
going to say, if you're up for it, Harry, I think it might be useful for founders just to hear how you calculated it and hear Engin's perspective on how you calculated it. But maybe we try to do that in like 90 seconds. How does that sound?
Yeah, sure. To be honest, I don't really need to pull it up. I can just talk you through the logic.
Sure.
So very briefly, we're a mobile application that connects people based on shared hobbies. I don't like this analogy, but think about us as Tinder for hobbies, right? That's kind of the model. So the logic behind the TAM was that there are about 100 million 20 to 40-year-olds in the UK and the US. And we have done market research that said that 95% of adults have a hobby that they spend at least an hour a week on. So if you do 100 mil times 95%, and then you multiply that by our monthly subscription cost, which is $5.99, multiplied by 5 months, that gets you to a TAM of about 2.9 billion. Also, in our market research, 65% of the people we interviewed said that they have actively tried to find someone to do their hobbies with. So if you do 65% times the 2.9, that gets you a SAM of 1.9 billion. And then for a SOM, we just did, even if we captured 5% of that market, that gets you to a 94 million SOM. That was the logic behind what we were doing.
Interesting. When I say interesting, so the 599 that you said 599, right? That you stuck into that calculation. See, that's Emin Purdy, correct me if I'm wrong, but I guess the two differences between the two ways of doing this is, one, you're almost going bottoms up based on your actual interview responses and your charging. You're going from your company and then creating the market, because I guess what you're saying is this doesn't exist today. So we can't take, we can only take the largest bubble, right? Which you said is what? People with, where's that? What's the source for that? People with hobbies that spend at least an hour?
Yeah, it was 100. There's 100 million 20 to 40-year-olds in the UK and the US, and it was times 95%, which is people who basically do their hobbies.
100 million. Oh, wow. To me, that
people
sounds low. 100 million people. That means what? 300 people don't actually care about, don't actually spend more than an hour on anything, which actually makes sense. People tend to be very boring animals. Okay. What I was going to say is, the flip side of doing this, do you agree with this, is trying to find bubbles, all three bubbles, without actually plugging in your 599 assumption in there. But I don't know how you'd actually go about doing that, because if you're claiming that this market doesn't actually exist today, then I guess you're going to have to plug in an assumption like this, that you're creating this market, and if you capture 5% of it. I would also question this capturing percentage, because again, you might want to bring some external examples into this, saying this company captured this percentage of their market, because 5%, it's an arbitrary number. How do I know it's not 1%? How do I know it's not 10%? I know you got to come up with some number, but for me, every number that you bring in has to mean something, right? You brought in $5.99. I could tell you, I know you won't have this answer, but if you charge $3.99, are you going to capture 20% of that market, right? So all these bubbles are so, especially if you plug in your numbers, they become so arbitrary that, to me, it almost makes the page pointless. I mean, because what you're telling me is essentially your financial projections in 5 years. When we charge $5.99, I'm going to make this much revenue. You just turn that into bubbles and put it on a different slide. To me, all you're saying is the revenue that you're going to make when you grow to a level that you feel, you know, is a good level. Does that make sense?
No, it totally makes sense. And you're absolutely right. That's why I think the financial model is much more valuable. And you're right. I have done it bottom up. The logic being, you know, I can, as you say, I can get the kind of top down number of people, number of addressable type people. But at some point, I've got to plug in a financial figure. And I did that based on our financial figures. Yeah.
I'm just going to, we
yeah.
can get through more, but Engin, regarding your question, that was the same thing that Harry and I chatted about yesterday, which is why I was like, let's get you on the call to ask live. So I think the TLDR and TAM is, we all have kind of no idea, but whatever you put on there, just be able to justify it. Great, case closed. Okay, Ivo, you're up first. And then Alessio, you've put a good question in the chat. Do you want to ask it live and maybe add a little bit more context there as well? Okay.
See, Alessio has a big number behind them. I wanna know what that number is.
Okay, Ivo, we'll go to you first and then Alessio.
Right. Yeah, thank you so much for the talk. Very interesting to hear how you think. Very useful. In a hypothetical situation where I'm like, someone might have like 2 advisors on board and they've given them 50% discount on the next round, with the idea of, well, us being advisors, instead of giving you equity directly, you're going to invest a little bit of money, but we're going to give you great terms for your advisory duties. Would that situation happen to make you think, oh, I should be getting a discount on my round 2, because like, why are other people getting such big discount?
It will only make me think that because you just suggested it.
Right.
That's actually a good, that's actually a very good question. You know, I don't actually have to preach to the choir, but what's my favorite thing with Hotbed is they don't actually take equity, they take warrants. They get the right to invest in your upcoming rounds within a certain period of time at a certain discount, right? So only if they bring money to the table will they actually, their warrants will actually be meaningful. So I think it's a very similar logic. What you're doing is giving your advisors essentially their warrants, 50% discounted warrants for the next round. I think that actually makes sense. It depends on how much of their time on a regular basis that you're taking. I would probably advise a mix of the two. I mean, I understand what you're saying is if you invest 1, we'll give you 2. You know, I don't know. If it depends on your relationship with them. I don't think there's a general, I think it's tough to generalize about the advisory shares and relationships because everyone is different. You know, if it's someone you talk to on a weekly basis versus monthly versus every 3 months or 6 months, or if it's someone that helps with something very specific, I think the answer really changes. But someone who contributes on a regular basis might also want something upfront or that's independent of their investment. It also depends on the advisor. If you know they have, or if you know they typically invest in similar situations, then what you laid out makes sense. But this is really, as much as I hate that, because I lived in Japan for 17 years and everyone answers it case by case basis, but this answer is really really depends on your relationship with the specific advisors. And guess what? You don't actually have to offer the same deal to your two advisors unless they're really very close with one another. So you could have different deals with different people. Companies that I've looked at that have a variety of advisors, you know, some of them get 25 bips, some get 50 bips, some get 1%, some invest and get 2%. So it's really a mix. Even in the same cap table, there could be multiple advisors with multiple deals. So I think it really boils down to your relationship with them and their ability to put their money where their mouth is, or, you know, if they're in this business or not, really.
Yeah. But let's say,
I'm
sorry.
gonna jump in there because we don't have time for follow-up. Sorry, Evo. Alessio, I'll go to you, but I want to get through a few more questions. So let's make this one really fast.
Yes. Actually, thank you so much for your amazing information. The specific questions was when we talked about net profit and balance sheets for pre-seed and seed round company. For me, it was really difficult to understand what about net profit. For sure, you can have a startup that might create a profit in the same month. But the question was, what about startup that don't have any revenue stream? How do you create the valuation? And then you answer with finger in the air, more or less. So that was the question.
No, let me, if that was the understanding, let me correct it. Well, valuation, finger in the air, I mean, it depends on the model that you build. What I'd like to see is granular projections, your number of customers, however you're going to generate revenue. You need to have a revenue page and you need to clearly lay out what's going to make you money. You need to show me your revenue model. You need to build up your revenue and tell me, today I have 0 customers. In 6 months or in 3 months, I'll have 12 customers, then 25, then 50. And these customers are going to make me this much money. So it's not finger in the air. It is, I mean, you know, that's why I said you need to at least multiply 2 numbers and give me a valuation. If you're pre-revenue, then the chances of you convincing me about how your model actually works are actually a little bit lower. That's where the seed, fast, and safe come in, because instead of us, you know, pushing one another and possibly losing each other over the valuation argument, that's why we go in with the safe. And then in 6 months or 12 months, when you actually hopefully have some revenue coming in and this and that, when you're raising the next big check, then we actually value it and we go in with a discount to that valuation. So that's why if you're really keen on doing a valued round at this point, pre-revenue, then the chances are it needs to be a friends and family round anyway, who will argue less. There's a founder among us whose friends and family round we actually invested in. So, you know, at that point, it's really more of a relationship-driven investment. Again, back to the 10-year thing, you really think you want to support these guys and you feel like you're getting in at a really ground level valuation and you want to support them early on. So does that make sense?
Yeah, it does make sense. And what clicked in my brain when you said, we invested into friends and family, I did the...
I lost you there. I think you're on mute.
Sorry. We got to move on to the next question because we just have 1 more minute. We have a good question from Heather who's asked, she has essentially, like, I'm going to mess up the pronunciation of it, but it's dyslexia for numbers. And so she can't hold numbers in her head, but she's wondering what your advice would be for pitches when people assume you should know your numbers, but she can't.
Well, I think you can be upfront about it. It never hurts. If that's the case, just tell people. You could even put, I mean, you could put this in an email. You can have someone with you, like yesterday, the call we had, it was with a founding team of 3 people. You should be very open about it, because this, especially if they invest, this will obviously keep coming up. You either not need a CFO or a finance person, but you can have someone who's more, I mean, you don't need to memorize your numbers, don't get me wrong, but you need to understand the logic of your model and be able to walk someone through it, right? And if you cannot do that, then you should have someone with you who can do that. And you can be open about this and say, look, I have this issue with numbers. I can't remember them, or I have difficulty, whatever it is. Just be open about it and have someone else do it. There's nothing wrong with that, as long as as long as that support is there, built into the company. Not everyone has to do everything. So I'm not saying the CEO has to be always memorizing their numbers. It could be two co-founders, and typically one is the raising co-founder, and the other one may be the one actually continuing to run the show while the other one's out there raising. So it just needs to be a good division of labor, and people really focusing in on what they do best.
Nice. Okay, one last question. I see Tesh is here for the next session. This is a really good question to end on there. It's from Julian. What aspects of the detailed model should be included in the 12-slide pitch deck?
So what's okay, what essentially what printouts from the model. I assume Purdy and Emma have already told you never exceed, well, hopefully 12 slides, but let's say 15. The reason for that is you should go to DocSend and find the article. However many slides you put in there, the average time you get, I think, is 2.5 minutes, 150 seconds. If it's 10 slides, it's 15 seconds a slide. If it's 30 slides, it's 5 seconds a slide. So your financial slide, let's call it a financial slide, needs to be punchy enough, just like every other slide. Every word, every number on there needs to hopefully punch above its weight. It needs to be sexy, it needs to be punchy, it needs to attract attention. It needs to, if I drill down on it, it needs to get my interest levels to a point where, okay, this looks interesting. It looks interesting, it looks believable, it looks sexy, it looks like I want it, this is the tip of the iceberg. It looks like I really want to drill down into the model and figure out how you got to those numbers. So what I would say is probably your main figures from income statement, your sort of top line revenue, if there's a breakdown of it, your expenses, maybe your a couple of 2 or 3 sort of major lines of expenses, and whatever comes underneath that. And then, balance sheet or balance sheet cash flow, you should show your cash balance. From the balance sheet, you maybe not much more than that. If it's an asset driven business, you should show your asset balance. I'll think about that, and I'll get back to you on that. That's a good question. But I think it's really, probably not more than a total of 7-8 lines across the 3 statements. And then some of your assumptions. If you have your customer numbers, if you have whatever is driving your top line revenue, that would probably also be good. The drivers of your model, your KPIs. I know I'm 3 minutes over, so I'm shutting up.
Perfect. Thank you. Okay, we're gonna wrap it right there. Engin, where can founders find you? We'll send out your LinkedIn. We'll send out the 2121 website. Anywhere else?
Absolutely. Feel free to add me on LinkedIn. I'll send my LinkedIn on here now. I would highly recommend, we've had this in previous cohorts, I would highly recommend waiting for a couple of weeks and finishing Expand before you send me a deck, because if you send me a deck now, you might suffer from the first mover disadvantage before getting what Purdy and M will actually be teaching you over the next 5 weeks, and all the other guests. You probably don't want to be that one, unless you're already way into your fundraising and you're going to be closing in the next 4 or 5 weeks. Then be my guest, get the decks going. Yeah, I mean, I'm generally happy to look at something. Remember, before you ask for someone's time, do your homework, know what they're up to. And if you're gonna, send me do your homework before you ask an investor for their time. I almost never give meetings out before I actually look at a deck, and I'm actually generally happy with the deck that I'm looking at. So I'll stop there. Thank you very much. And I'm more than happy to interact with everyone. I'll put my email on here as well. and we'll take it from there.
Wonderful. Thank you so much, Engin. We will say goodbye to you and we'll welcome Cash back up. Everyone wave goodbye to Engin.
Bye again.
Thank you.
And
Bye-bye.
I'm just going to stop recording, but can you start recording from your computer on the cloud? Because I want to switch it to gallery mode for this so I can see everyone.